Good morning, everyone, and welcome. My name is Will Hartley, Marketing Coordinator with Smoker & Company, and I'll be serving as today's moderator. Firstly, thank you for joining us for another webinar in the Smoker & Company 2026 Insight Series. We're excited to have you with us and appreciate you taking the time to be part of today's conversation. For those who might not be familiar with us, Smoker & Company has been serving Central Pennsylvania for more than 40 years, providing accounting, tax, and advisory services to businesses, organizations, and individuals throughout the region. Today's presentation will be presented by OneSource Business Solutions, one of the companies within the Smoker & Company family. OneSource has helped business owners navigate important decisions related to value, growth, transition, and sale of businesses. Our topic today is what is your business worth and why it matters right now. Many business owners do not have a clear or current understanding of their company's value, even though that information can play an important role in planning, growth, financing, ownership changes, succession, and long-term success. Before we get started, I'd like to mention that we'll be having a Q&A session at the end of today's presentation. If a question comes to mind during the presentation, please feel free and enter it into the chat at any time. We'll collect those questions and address as many as possible during the Q&A session. At this time, I'd like to turn things over to today's presenter, Jeff Shelley of OneSource Business Solutions. Jeff will introduce himself and guide us through today's topic. Jeff, the floor is yours.
Thank you, Will. I appreciate that. We are right here in downtown Lancaster, along our office on Duke Street, and we're going to talk about business valuations today. A recent survey done by M&T Bank just a few years ago found out that 98% of business owners really didn't know the accurate value of their business. And to some extent, it's kind of like getting your investment statement in the mail and not opening it and putting it right in the shredder. You know, you have assets there, but you don't really know what it's worth, or, you know, looking at getting your checking account balance and not really, you know, seeing what it is, just kind of glossing past that. So it's for many business owners, it might be the largest single asset that they have, and they don't really realize it. They don't see the growth that it happens every year because they're busy working in their business and maybe managing employees if they have it and dealing with customers, and so they don't kind of focus on their business, and it could be an investment that could be grown over time, and also looking at the factors that affect the value of it as well. There are a number of benefits regarding getting a business valuation. Firstly, understanding the value of your business. I mean, obviously that's key if you're thinking of selling it now or in the future, or for a number of other reasons as well, like smarter strategic decisions. If you're thinking about expanding your business, or, you know, getting new customers, creating a new product line, or maybe even hiring an employee, or first employee, or additional employees, you know, knowing exactly the size of your business and your path forward, you know, can help you make that decision. And also, if you're looking to exit anytime soon, either to sell the business, move on to something else, or to retire, you know, kind of looking at doing that before you have to do it, and making those decisions can be beneficial as well. As well as looking at any growth opportunities and, you know, ways that you can expand the business, and maybe, you know, realize the value that you have in the business now can help you do that. And also, it does help with financing. Certainly, a bank is not going to lend solely probably on the value of your business. It's going to look at other assets and the hard assets of the business, like your furniture and equipment and those types of things. But you know, certainly it doesn't hurt to have extra assets, you know, on the scale when you're going to the bank to ask for money. There are a number of different things that will trigger a valuation, or, you know, make them occur, and we'll talk about these in a little bit of detail. Business planning and expansions, like I mentioned, you know, knowing when to make the right move, buy-sell agreements, having a fair price for an entering partner, a bank financing, once again, kind of making your position a little bit stronger when talking to the bank, and also there's certain legal things that will require you possibly to do a valuation, like divorce or a death in the family. Mergers and acquisitions, you know, a larger company buying a smaller one, either side might want something done. An ownership buy-in, buy-out, just like the buy-sell agreement, you know, with someone coming into a partnership or someone leaving. Succession planning, when you have another generation coming in, maybe a son or daughter, and they're, you know, they need help maybe getting in, afraid of, you know, making that big decision to purchase, and kind of making it their price for both. And there are some folks out there who just want to know the value of the business as well. First, business planning and expansion. Certainly, some people they look at their business as an asset, and in doing so, they want to see what the value of it is now and look at growing it in the future. So, starting with the baseline now, and then seeing how a business grows. I know one of our clients we've been working with for over 10 years, and they're a manufacturing concern, and about 11 years ago, we did an initial valuation for them to start a baseline for them because he was interested in growing his business. And I think he had 3 employees at that time, and we valued it right around 150,000. And we did one for him just last week, and he's at 1,750,000 because he's looking to spin off one of his product lines and have it be purchased by another employee. So in that case, he wants a price that's fair to him because of all the blood, sweat, and tears that he's put into the business, and obviously the buyer wants a fair price as well. So business expansion and planning certainly is important. Also, a buy-sell agreement. A buy-sell agreement is generally a part of the operating agreement that is required for the operation of a limited liability company. And to be fair to everyone, sometimes if it has multiple partners, that operating agreement will require that an outside valuation be done, just for the fairness of all parties, and also so that so that it's valued in the same way, the same methodology. And we'll talk about that methodology a little bit in the future. Bank financing is another option. Obviously, like I said, banks generally will not give loans just solely on the cash flow of the business, but it can be a supporting factor, and certainly assets, but income. But if we present that income in the most favorable position for the company and in a true light, that can help with some bank financing as well. There's certain legal things that could trigger a valuation. Unfortunately, if someone passes away and they're a part owner or full owner of a company, and that business is not sold and it's taken over by a family member or existing partners, many times the estate will need a valuation to claim for the estate tax return, and also divorce settlements. Right now, strangely, we're working with a number of divorce attorneys and working and valuing some businesses for their clients in a number of different capacities. Because anytime a business is held by one of the parties, they will want to seek the equity in that, and also for any intergenerational gifts or other legal items that might require some kind of valuation. Mergers and acquisitions, also another factor that might trigger a valuation. And of course, we're just talking about typically one company buying perhaps a smaller company, and many times a valuation can be used as a defense mechanism. If a larger company is trying to pressure a smaller one into maybe a price that's a little bit less than what they feel they're worth, a third-party valuation can help bolster their position. As well as an ownership buy-in or buyout. That's very similar to that buy-sell agreement that we just talked about. Once again, it's a fair third-party assessment of the value of the business, looking at the cash flow and so forth. And once again, doing the valuation the same way each time, so that if one partner buys in this year and in 3 years they sell, and a new partner buys in, or maybe an existing partner buys a larger portion of the business, the valuation will be done in a similar fashion. And the numbers may change because the income is changing, and maybe other factors might change, but the methodology be the same, and thus fair for probably all involved. Succession planning, of course, is key, and that might be one factor where you want to look at the business initially. When you're thinking about retirement, it's on the horizon, and you have some plans and some dates set. But then, obviously, what's really going to impact is what the value of the business is when you do retire and when you do sell it at that time. But knowing what a preliminary value is can be helpful, because then you can help plan, for when that date comes. And if it's not meeting your retirement goals, maybe you have a goal of how much you would like the business to sell for at that point, then you can make certain strategic moves to help bolster the value of it, to help grow the business before you retire and make it a stronger number. And also, there are some people out there who just want to know what the value of it is. Like I say, they go on Zillow or whatever, and they check out their home price maybe, and they're interested when that goes up a little bit of money. And a business is the same way. We look at the cash flow of the business, but make certain adjustments to it. And some people just they do value it as another portion of their investment portfolio, and look at it just like they would look at something else that they would invest in and hopefully get some money from. So what goes into a valuation? We've talked about kind of what might trigger it to start. Maybe someone's just desiring knowing what it's worth, or a legal situation, or they're looking to sell now or in the near future. To do the valuation, really the value that we come up with a single market value when we look at the value of a company. And really, when it gets down to it, the value of the company, that one single number, can best be described as the current value of all the company's future cash flows. So what you're really doing is you're buying the future business that that company is going to give its customers, and the profit that it's going to give its owners. So to estimate what that value is going to be, we look at the tax returns or financial statements, and we look at 3 years of activity. And then we make certain adjustments to those, making sure that all the expenses are at market rate, and there's no personal expenses that might have, found their way in there, and so forth, and just make a true assessment of what the cash flow of the business is. And then we apply a multiplier to that. So basically, it's kind of like third grade math when we finalize it. We do certain adjustments to our average of the last 3 or 4 years of activity. We look at what that average is. And then we create a multiplier based on the individual business itself. And we have a proprietary software that we use at OneSource, and it's been here as long as I've been here. And I've looked at a lot of other valuation methods that other companies have used too, to give our opinions on other purchases and so forth. And I really like our valuation method that we use, honestly. And we look at 15 individual characteristics of the company that create that multiplier. So the multiplier might be higher if the company is performing very well and has good customers, great employees, and top tier management and all of that. And it might go down a little bit if some of those things are lacking. So we look at 15 individual characteristics, such things as net income. Obviously net income has to be strong and also improving. That makes a company more valuable. So if you look at your company and you have a valuation done, you can see what factors impact the value of it, and how you can make changes to that to help the value grow within the next year, 2 or 5. So net income is one factor. We look at how old the company is. A company that's older would be valued perhaps slightly more than a company that's 1 or 2 years old, because the rate of failure for a new business is extraordinarily high and just decreases every year that it's around. And also, customers like to do business with someone that's been around for a while, because they think they're gonna, they'll be there for them in the future. So that's one factor. Company growth: is a company growing or is it declining? I mean, obviously, that's one thing we talk about with folks thinking about retirement. If they tend to slow down a little bit, maybe, maybe not be open Friday afternoons, or just kind of decrease activity a little bit. That will hurt the growth. And a buyer wants to look at a company that has growth, and they see that there's room for them to expand things. The competition: we look at the competition. I used to have a friend that says, all you need to do to be a contractor in Lancaster County is have a pickup truck and a hammer. And that's changed a little bit, but not a whole lot. So there's a lot of people out there doing just what you're doing, but maybe not quite as professional. And if you can stand your company apart from them and make inroads with your customers, that's good. And we can, that would certainly rate your company a little bit higher than the average. We look at your business expansion. How easy or difficult would it be to expand your business? Either a new product line, or maybe new customers, maybe go into another geographic region. If you have that ability to be flexible, it makes your company more valuable, and will make the final value of your company higher as well. How are the competition coming in? Is it easy or difficult for a new competitor to come in, to open up shop right next to you, or down the street, or advertise on Facebook where you advertise? And if it's hard for someone to come in, if there's takes a lot of equipment to be purchased, or a lot of technology, or knowledge base to do what you do. I mean, obviously that raises the value of your business just slightly. All of these factors are incremental factors that add value in very small blocks, but do increase the value of your business. And you can certainly see how your business would compare to a competitor. Maybe some are a little bit healthier in some areas, and certainly maybe you're better in some areas, but everyone adds up just a little bit differently. We also look at customers. How many customers do you have? Obviously, 1 or 2 large customers would probably not be as good as 100 or 200 smaller customers. If one of those big guys goes and the customer leaves you, you might be hurting for sales. Management retention. We sell businesses here at OneSource. We have a wide variety. I always say, we've had businesses listed for 4 or 5 million, and one time we sold a market stand for $5,000. So we're in all aspects of small business. And sometimes management does not stay. But if there is existing managers or one manager or an operations person and existing employees, that certainly helps build value. Some people are looking for single owner operator businesses, and there is a market for those. But if you have some help in operating the business, that makes your business stronger. I mean, if I don't have to be at work at 8 o'clock and my business opens up and runs without me there being the owner, that makes a business a little bit more valuable. We also look at your location. Where is the business located, and can it continue to be there? How is the lease, or is it owned by the current owner? Can that continue? And then we look at equipment. Do you have equipment? What's the status of it? Is it in good repair, or is everything, could probably be a little threadbare and could be replaced a little bit ago? So, we look at that. I mean, obviously, if someone wants to step into your shoes and run your business, if you're thinking of selling at some point in the future, if everything's up and running and the key turns in the door and everything operates great, certainly there's more value there than sending equipment to the shop whenever that's needed. Also, we look at financing and the interest rate that can impact the value of a business. I mean, a business value is not just tied to the operation of that business. There is a small portion of it that is impacted by the interest rate. So, certainly it can be a price of a business, and that price might be fair in general. But if the interest rates are high and the money can't be afforded to loan and pay that back, that might impact the value of it too. So we do look at the availability of money or banks lending and the interest rate, the cost of money as well. And the industry, we look at the industry. There are some industries that are growing, and some that maybe are shrinking back a little. There's legacy industries that, are kind of, maybe there's certain shops or, institutions that are kind of like going down, and ones always that are kind of coming up again. So, the industry, a stronger industry, one that's more attractive, easy to manage, perhaps from a new owner standpoint, that might garner a little bit more value. And then we look at the environmental assessment of the business. Certainly, with pollution being a concern, with public opinion being a concern, perhaps a bad review online or several or something can certainly hurt a business. So we look at those types of things. And then the owner, how is the owner the face of the business? Are they the ones maybe, every customer talks to, or perhaps even commercials are done, with their face, and if they go away, will that impact the business negatively? And also, finally, we look at 15 individual items. Like I said, the last one we look at is, alternative investment returns. I always say, if I had the same money to invest in a business, should I buy a stock, or should I buy this company, or just stick it in the bank and earn some interest? So, there's a variety of different things. If the company is not hugely profitable and just kind of bumping along a little bit, maybe it's not as attractive as it would be. So there's a number of different factors that, are kind of obvious when you kind of break them apart, that what does add and subtract to a value of a business. And also, when you look at kind of how a business can be measured now, we discuss those factors, with the business owner when we're doing the valuation, and get their opinion on their business and their place in the marketplace, and to kind of get their impressions on all these, because you can not only kind of see what a company is doing now and see what its income is and the revenue and its customer base and management and so forth, but you can also see, okay, where are the soft spots that could be improved now, and the things that are going well that should also be kind of expounded upon as well, and doing all those things in the right way. You see where you are now, but it would also kind of improve not only the operations of your business, but improve the attractiveness of your business for a buyer as well. So it's kind of a win-win situation if you look at your business and see where the improvements can be made and make plans for the future. So there's a number of different things that go into the valuation. We do look, like I said, at the cash flow, the net income, and look at those other factors that both add and subtract to the value of a business, and we come up with a fair market value for the open market for the businesses, is how we calculate that. Really, with the valuations that we do, it's knowing the value so you can plan, protect, and grow your business with confidence, is what we say. Just to do that and kind of know where you're going, and know where you are now. We at OneSource, we do business valuations. We also do general consulting work and helping people grow their businesses in some of the ways that I just alluded to a little bit with regard to the valuation. And also we help people sell their businesses, either a closely held transaction to someone they know or someone in the general public that they don't know yet, but finding the right person to buy that business. That's what we specialize in.
Wonderful. Thank you so much, Jeff, for informative presentation and for sharing your insights on why understanding a business value is so important. We'll now
Thanks, Will.
move into the Q absolutely. We'll now move into the Q&A portion of the webinar. If you have any questions, please submit them in the chat and we'll address them as time allows. To start things out, Jeff, for a business owner who has never had a valuation completed, what is the first step?
Well, what we do is I think it's important to know the process before we start it. So I usually go out, sit down and talk with business owners, show them a copy of a report that we've done to kind of give them the format, and we can start the process right away. We get 3 years of financial information or tax returns and have a discussion with them, some questions, and do the valuation like that.
How often should a business owner update the valuation of their company?
It's really their call what they can do. A valuation is deemed to be good for at least 2 years. A business value, a small, closely held business, doesn't change value too dramatically from one year to another usually. So, every 2 years, certainly. Some people like to do, every 5 years or something like that to see the growth of their business and kind of know where they are.
Great. What factors tend to have the greatest impact on the company's value? I know you listed several there. And what are the steps owners can take to improve that value over time?
Right. So, I mean, the main ones or the financial ones, the rising revenue, increasing sales, a good customer base. And, I think if they look at anything that like improves the operations of their business inside and, makes it, a little bit easier to operate, I think that buyers really appreciate a well-run business. And like I said, if there's certain things handled, all in-house there and not everything has to be handled by the owner, I mean, that can be very attractive to a buyer and be something that could improve the saleability of it. People, sir, a business is a collection of a whole bunch of items. There's employees in there and equipment to do the work and all the other items. This owner has taken all the work of putting all those items together efficiently and effectively, and that's what makes a well-operating business so much more attractive than a business that might just be bumping along. And so those things that they can do that a buyer can see, I think, really make an impact.
Great. Here's an interesting one. How does the purpose of evaluation, such as succession planning, financing, ownership changing, or potential sale, affect the valuation process?
Well, I think the one thing that people maybe hesitate to do or don't do is kind of planning ahead a little bit, especially with a transition to a new generation or retirement or something that is like that, or thinking of selling at a particular date. And especially if you have someone coming into the partnership, like I said, maybe a new generation, or just to find out what we have as an estimate value so they can make their own plans. Like I said, to purchase in, especially if it might be a younger person to buy a business or part of the business, that can be a big number, just like buying a home. That can be something that you take a few nights and consider. So I think if you make your time and they can see the value and also see what you if you're loaning money for that, see what that loan is going to be and be comfortable with that and know that it's a doable situation. So I think information is a good thing, and I think planning is a good thing, and I think that alleviates some concerns with a big life decision like that.
Wonderful. Here's one that just came into the chat. How do you handle when personal expenses are in the business?
Well, we take them out. When I review the valuation with business owners, one category, one column is their numbers, and then we have another column of adjusted numbers that we've made changes to. So it's not uncommon to have some personal expenses commingled with business. It might not be totally desirable, but it certainly happens, and banks realize it happens too. I know I was taken aback a few years ago when one of the banks asked me, what expenses will remain with the cellar. In other words, what is what is the business paying for that the new guy will have the business pay for? So they realize it happens as well. So yeah, we take those expenses out and we make other expenses market rates, such as rent and wages, and make sure they're appropriate for whatever the building or person is.
That's great. Thank you. Let's see here. Here's another one. Can you explain the difference between an informal estimate of a value and a professional business valuation?
Well, the difference really is what we just talked about, I think.
Okay.
It's kind of going into the weeds, if you want to say it, or going into the detail and looking through the expense accounts and making sure that everything is appropriate and kind of, I mean, I did auditing financial statements for a number of years right out of college, and this is not an audited financial statement, but we do look at things a little bit and make sure that the numbers are accurate and make sure that, the underlying factors are correct too, like you said, all those numbers and so forth. So yeah, we would make adjustments and take out anything that that wouldn't be business-like, and make any adjustments like that.
Great, great. Well, if we don't have any more questions, this will be the last one for today. What are, in your experience, what are some of the most common misconceptions business owners have about what their business is worth?
Well, there's two, I think. Either they think it's worth too much or too little. And I'm being very serious because there are some people, and that's why I mentioned kind of silly that we sold a $5,000 ice cream stand one time, because we did. Our goal here is to make business move forward for everyone in the area. It really is. So however we can do that. And I think that I think planning ahead and once again making sure that communication is there. If it's someone buying in, or someone in the family, or another manager or something like that, and just doing things like that.
Awesome. Wonderful. Thank you again, Jeff. And unless there are any other questions, we'll conclude today's presentation. We hope you found today's session informative and valuable, and that you leave with a clear understanding of why knowing your business's value can support better planning and more confident decision making. As I mentioned, this webinar is part of the Smoker and Company 2026 Insight Series, and we look forward to bringing you additional topics and insights in the future. If you have any additional follow-up questions and you would like to contact OneSource to discuss, Jeff is available to answer any of your questions, schedule a confidential confidential meeting to just answer your questions. Whatever you need, OneSource is here to support you. And on behalf of everyone at Smoker and Company and OneSource Business Solutions, thank you again for attending. We appreciate your time and participation, and we hope you have a wonderful remainder of your day.
Thank you.
All right. Thank you all.